Great. Well, thank you everyone for joining us. And if you're new, welcome. And if you've been here before, welcome back to BFSG's 2026 Summer Webinar Series. This is week one, talking navigating volatile markets. This is a topic that we do probably every year and a half to 2 years, just by popular demand, as well as bringing back anytime markets seem a little volatile, or there's a big headlines out there that people seem worried about. And we do have some slides to address that today as well. With that, Keith, you want to advance it for some introductions? My name is Chad Nurani, right in the middle. There's the host and moderator and facilitator and leader of the Q&A. I have with me Keith Johnson and Mike Albee. You two want to introduce yourselves?
Great, thanks, Chad. Again, my name is Keith Johnson, certified financial planner, senior education specialist with Benefit Financial Services Group. So essentially what I do, I work directly with retirement plans and participants in those plans, helping people plan for retirement and other financial goals along the way as well. So Mike, I'll turn it over to you.
Thanks, Keith. I'm Mike Albee. I'm also a certified financial planner. I've been with BFSG for 18 years or so. Lose track of time. But I also work with wealth clients as a senior portfolio manager. So focus more on the portfolio management side, talking about navigating volatile markets today. So we'll talk about some of the things to do in portfolios, focus on, and trying to ignore the noise.
Thanks, gentlemen. As a reminder for everyone out there too, this is being recorded. We will have a replay link available. It'll come through 2 emails tomorrow, one from Zoom automatically, and then one from our team. There will also be available a link to the PDF slide deck. So no reason like to screenshot them. You will have the full slide deck that we cover today within probably 24 to 48 hours of closing out today's session. With that, guys, I mentioned, we do this anytime there's some big headlines. I know there's been a lot of big headlines over the last year or two. Let's kick this thing off.
Great, thanks, Chad. I think, going back to Mike's point, trying to eliminate that noise, disregard it, that's incredibly difficult. So we'll talk about that today. We're going to focus on what's happening in the markets right now, and more importantly, how you can manage your investments with confidence when the markets are volatile like they are right now. So we'll talk through some practical ways to keep perspective when the markets get choppy, and how to make sure your strategy that you have in place still fits your long-term goals and you're not wavering from your plan. So overall, this is meant to be approachable. So there's really nothing you need to know already coming into this. So why don't we jump in? And here are some of the headlines we were talking about, and I'll take us back a little bit here. We've seen all the headlines over the last few years. March 2020, stock market suffers one-day drop of 12%. I'm sure everyone remembers that one. Same month, March 2020, S&P 500 hits bottom and loses 34% of its value. And then August 2021, what happens? S&P 500 doubles from the pandemic bottom. So while that downturn caused by the COVID pandemic, it was one of the most severe in recent history, what happened on the flip side, we also experienced one of the fastest recoveries ever. So here we are now in 26, kind of have our own version of those headlines. So what's going on right now? Conflict between the US and Iran. Softer than expected June jobs report, and growing questions about, everyone's hearing about AI, whether or not AI stock valuations, maybe they've run too far ahead of fundamentals, and then so on and so forth. So I've been doing this for about 30 years. And with that being said, over those 30 years, I work with a lot of clients. They say, okay, is this a safe time to get into the market? So when you ask yourself that question, what are you trying to do? You're trying to time the market by jumping in and out of the market, which is virtually impossible, and definitely impossible to do that with confidence. No one can say what's going to happen in the future. So we'll talk about this a little bit. It's focusing on what you can control. Talk a lot about diversifying your portfolio, then investing for the long term, not getting caught up in that short-term noise. And then also, and this is incredibly important, saving as much as you can and as early as you can. And when we go through all of this, just keep in mind, volatility This is a very normal part of investing in the market. It was here 100 years ago. It'll be here in the next 100 years and everywhere in between. So that's important to realize.
And I would just add to that, Keith, if it was easy, everyone you wouldn't get the returns on that prior slide. It showed the S&P over that 30-year period averaged roughly an 11% return with all those headlines. If there was no noise out there and everything was kosher and you wouldn't get those returns. You'd go get treasury returns, cash like returns. So the volatility is really it's a friend of yours to help you compound at those greater rates of return.
And it almost staying, of course, rewards the long-term investor because a lot of people they went to that flight to safety in the form of cash, like you were talking about, Mike, treasuries, whatever the case. There are other risks involved when you do that, and the big one is what? Inflation. So if we're not outpacing inflation, that can erode your retirement nest egg. You're losing your purchasing power. So that's incredibly important to build that. And again, we'll go into more detail, that diversified portfolio. So as we take a look at this here, as the market's climbed over the last 15 plus years, an investor's risk tolerance, that didn't seem to matter because for many of us, it felt like what? The markets are just going to keep going, I'm all in. And technically speaking, over the last couple hundred years, they have trended upward. But again, not without those times of real volatility like we're seeing right now. So what I just mentioned, the fact that volatility is very normal, you'll experience recessions throughout retirement. So again, those factors you can't control. Instead, focus on what you can control. So we'll go into a little detail there. And I mean, generally speaking, most investors definitely overreact to market downturns. And these bear markets they're not easy, they're very challenging. But bull markets have historically been longer and stronger. So the bottom line here, we need to keep calm, not make any decisions based on the news report of the day. So the unfortunate reality is that for many individual investors, it's very hard to stay calm in the middle of a crisis. So if you're someone, maybe you hit that panic button in the past, you sold during a market downturn, something like that, it very well could be a sign that your portfolio is not aligned with your risk tolerance for investing, not diversified properly. So that's what we'll, again, focus on what we can control here. And again, I mean, obviously everyone on the call probably knows stock market returns are unpredictable. But the long history of positive returns may be reassuring to investors who find downturns unsettling, I guess you could say. So up years have occurred far more often than down years in the US stock market from 26 through 2025, with an average gain of about 10.3% during that time period. And roughly 3/4 of the down years, what happens? We get that bounce. They're followed by up years. I think a good recent example here is what would the market lose in 2022, Mike? About 20%?
Yep. 18, yeah, 19%, somewhere around there.
19%, yeah. So followed by what? Almost a 27% gain in 2023. So I mentioned this earlier, the market tends to reward investors who can weather those annual ups and downs and stay committed to that long-term plan. In order to do that and accomplish that, we need to be within a risk tolerance for investing. So we think it's so important that at this point, I'll turn it over to Mike and he'll drill down a little bit more on why risk tolerance plays such a key role in building your portfolio over the long term.
Keith, before you move forward, actually, real quick on that last slide, I want to point out too, the average market return for the S&P 500 during that 100-year period was roughly 10%. Look at on the chart there, up 7 to 14%, the number of times the S&P hit the average return. Only a handful of times. This isn't like a normal probability curve of returns. You have a lot of up 20+% years in the S&P 500. unfortunately or fortunately, those best years typically follow the worst years. And so kind of going back to market timing, like, oh, like I know when to get out. You have to make the right decision when to get back in, and that's difficult. So if you look at like 2022, going back to the example Keith gave, down 18.11%. Um, if I find 23, 24 on here, right there, up 21 to 28% at the top of from the second furthest right column. So it's really hard to time markets, and volatility is kind of like the slide title reflects. It's just the cost of compounding. And when clients ask me, what are markets going to do this year? I kind of go back to history and go like, well, or do you think the markets are going to be positive or negative? It's like, well, you've got about a 75% chance that they're going to be positive and a 25% chance they're going to be negative in any given year, just based on history.
They basically go up 3/4 of the time and go down 1/4 of the time. So if
Do
you're
you guys,
jumping in and out of the market, it's impossible to time that. So again, to take advantage of all that, I mean, it's not all good, right? It comes with the bad too.
hey guys, and before you move on, because it is relevant, and I think it's going to be relevant to some future slides too. When you think about these average returns, how often has it been over the rate of inflation? And then can you very briefly talk about difference between inflation and cost of living, which is effectively the same thing?
Yeah, I mean, same thing. Cost of living inflation. There's always some inflation in uh, 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 the economy. I mean, unless we go through a deflationary period, but most of the time there's inflation, and you have to um, build a portfolio that's going to protect against that and grow at that above that rate of inflation. Inflation uh, today is, depending which measure you want to look at, call it between 3 to 3.5%. That's a coming off. I mean, the pandemic, it's been a little more elevated. It's averaged close to about 4% per year since the pandemic. But we went through a 20+ year period pre-pandemic where it was 2% or a little bit sub 2%. But you want to build a portfolio that protects against that, because especially if you're retired, and inflation is going to continue to eat away at your savings, and when you're on a fixed income. Sorry, Chad, go back to the first part again. The rate of return above inflation. Yeah, I mean, inflation has averaged, I mean, over a 50-year period going back to the 70s, maybe a little elevated because of that 70s decade, about 4%. So if you're earning 10% on stocks, that's helping you hedge against inflation. If you're earning 4.5%, 5% on bonds, it's helping hedge against inflation a little bit. But your bonds, we'll touch on a little bit later, are typically fixed coupons. That's the rate you're going to get it. And so if inflation moves up, it starts to chip away on that cushion of the yield. So.
Yeah, for sure. And I mean, that's one of the main reasons we invest in the markets is to outpace inflation. What's the other one? Taxes. So outpacing inflation and taxes, that's key in all of this. That's why sitting in cash over the long term, you might be in retirement longer than your working years, for example. So that inflation, it creeps up on, you don't see it right away, but you definitely do 10, 15, 20 years into retirement. And we've been talking quite a bit about inflation. There's the inflation everyone's accustomed to. What about healthcare? Are you outpacing healthcare inflation? I mean, that could be running 2 times the rate of traditional inflation. So there are a lot of moving parts here, if that makes sense.
And we'll touch on it a little bit later on, but stocks have historically been a good inflation hedge, because companies, I mean, can pass on costs, squeeze suppliers, so on. So they act as a better inflation hedge typically. So even though you may be going into retirement or well into retirement, typically we advise, like, I mean, it's all client specific, but you probably want some portion of your portfolio in stock still, because of that longevity risk Keith just talked about. But there's inflation, and you can't just move to a super conservative portfolio usually.
What do you think? Because I'd be willing to wager that we get this question. What do you think about gold as an inflation hedge, Mike?
Uh, Gold has a hit or miss, in my opinion, on as an inflation hedge. Gold did very, very well during the 70s and early 80s. And that's why I think gold kind of is known as an inflation hedge. But gold in other inflationary periods since then really hasn't tracked it very well. I mean, the pandemic when inflation shot up, gold wasn't doing anything until just about 24 months ago. So it's got a little bit of a more hit or miss aspect on as an inflation. And in my opinion, it's a non-income producing asset. So stocks, I mean, one, they can pass on costs, hike prices of their goods and services, but then you're also getting income, either stock buybacks or dividend income. So that's my preferred way to hedge inflation is through stocks rather than gold.
So gold's fine for wearing, maybe not investing in. Is that my takeaway here?
And if you're going to invest in it, it should be a smaller portion of the portfolio, in my
Right.
opinion. Yeah.
Okay.
So with that said, and Keith brought this up, and one of the things, I mean, why both Keith and I are on this, more focused on the portfolio side, Keith on the financial planning side, but you really need to know your risk, your develop a financial plan to know what your goals and needs are in retirement, because that will help you start to reframe the question of not asking like are stocks overvalued, undervalued, or are we in a bubble? Is it a good time to buy or sell? And these questions that start to get to more about timing the market and asking how much can I lose before I deviate from my plan. And again, that starts with having a financial plan in place and understanding your risk tolerance for investing. And so understanding that downside, at least historically, this is going all the way back to 1926. And if you start on the left-hand side of this chart, it's saying if you have a 100% bond portfolio, and then as you move to the right, you get more aggressive with adding stocks to the portfolio until you get all the way to the far right, and you got a 100% stock portfolio. The range is showing you the greatest calendar year gain, the green bar, and the greatest calendar year loss in any given year going all the way back to 1926. And then you see the black dot is the average return for that portfolio. And so we show this more to understand like if you had a moderate kind of 60-40 portfolio, kind of in the middle there with the 8.8% average annualized return over that time horizon, your best return was up 40%, your worst return, and this is, I mean, a general portfolio was down about 28%. If you went through a market with the 28% drop, we want you to make sure you're comfortable with that and not at the wrong time going get me out and being a forced seller. We'd rather be rebalancing into that weakness and buying at that. And again, that helps capture that power of compounding we were talking about, if you're willing to tolerate that downside risk along the way. And this is why it's so important to have a financial plan, because if your plan can't accept that risk of that downside, like if there's something called sequence of returns risk, right when you retire, the market goes through like a financial crisis like 2008. That can have a real impact if you're starting to withdraw cash from your portfolio for living expenses at that time. So those are things that we want to know: risk tolerance, financial plan, and guard against these downturns, but staying the course once that volatility arrives. And you should know this ahead of and plan ahead.
Hey, Mike, because this is exactly what you said, but in slightly different words. So just knowing we can't predict the markets and based on what you're saying, is it generally advisable for someone retiring in the next, 5 years or so to shift from a very aggressive portfolio to a more balanced or conservative option?
Yeah, I mean, it's all client specific. If you've been a great saver and it just kind of depends. We do recommend, I mean, as you go into retirement, you should have adequate, not just emergency reserves, but some cash, typically 12 to 24 months in cash and cash equivalents. Because if we do hit that crisis, then you don't have to be withdrawing from the portfolio right at retirement. But yeah, normally, I mean, on average, investors start to get more conservative as they get into retirement. And in some cases, we may go more conservative right before or near retirement for those first couple of years to guard against that sequence of returns risk, and then start to get more aggressive again, knowing that there's still 20, 30 years left. But it's all very client specific on how much they've saved, how much what their goals are, their spending. But yeah, in most cases, we're getting a little more conservative as they go into retirement. I would say most of our clients that go into retirement, and Keith, maybe you can, I mean, you do a lot of financial plans, but I would say they're probably around 50 to 60% stocks at that time.
50/50, 60/40 portfolios. Yeah, I think, and if you're not working with an advisor or an expert, this is simply a starting point. Some of you may have heard of this rule. I know Mike and Chad know it, the rule of 110. So basically, okay, how much should I have invested in the market? Again, it's just a starting point. You would take 110 minus your age. And then whatever that amount is that you come up with as a percentage, that's what you should have invested in the market. And as you get older, obviously that number is automatically reduced. So just a starting point if you're
Yeah.
not sure where to go with that. So,
But the rules of thumb, I mean, and we're quoting averages here. It's
yeah,
all very client specific on the strategy and based on your risk tolerance and other things. So,
correct.
um, and as far as, I mean, how much should you have invested in the market? It is a balancing act. As we're talking about, you probably want to gradually lower risk as you near and enter retirement, since you have less time to recover from losses. Um, uh, but you still need some risk to outpace inflation and taxes. And it's worth remembering, as Keith mentioned, I mean, healthcare costs typically, unfortunately, healthcare expenses go up more in retirement just because we all age. And healthcare inflation has been running around 5% or so. And so you could spend more in your retirement years, not just from healthcare expenses, travel that you put off during working years. So you need to balance that, meeting your income needs, the time to recover, peace of mind, inflation, all these things. If you're younger, just starting out, and this especially if it's a retirement account, uh, you're not touching this money till at least 59 and a half to avoid the 10% penalty, and likely later than that for when you retire. Uh, who cares what's going on? Keep investing in an aggressive portfolio, and let it compound. And come retirement, if you can keep dollar cost averaging, keep doing your contributions to your 401k or retirement plan, getting that match. Definitely should be more aggressive for younger folks on the line.
100%. But when you do, and it's totally fine to be aggressive, but when you do that, you're not saying throw everything in the S&P 500, because we still want that diversified portfolio, just an aggressive diversified
Yeah,
portfolio.
don't go throw it all on SpaceX and hope that works out. Stay diversified. We believe in global diversification, and and for that reason, I'll give an example. Like in 2000, we went through the dot-com bust. The S&P 500 pretty much moved sideways for a decade, and didn't really do very much. Small and mid-sized U.S. stocks, international stocks, real estate did very well during that 10-year period. So if you only invested in the S&P 500 during that period of time, you would have lost a decade of compounding wealth, of your 5 or 6 decades that or I guess 5 decades that you're saving for retirement. So we definitely recommend, I mean, being more aggressive. And when I say that, more stocks than bonds when you're younger, but staying diversified, absolutely.
Together with so many retirement plan participants here and sticking to balance as we move on to this slide too, right? Moving all stocks to a balanced portfolio. If you're using a target date fund or one of the asset allocation models inside of your employer sponsored retirement plan, those are actually doing this exact theme for you, right? If you're 20, 25 years old, you probably have over 90% stocks in your portfolio, and they do put some bonds for diversification. They're also globally diversified, US, large companies, small companies, international companies. And as you get closer to retirement, most of those target date funds within 5 years of retirement will have you at about 50 to 55% stocks in your portfolio too. So it really is a set it, forget it. And they are doing exactly what we're talking about on your behalf.
And if you use a target date fund, use one fund, pick the day you plan to retire and use that one fund. Because if you pick a bunch of different target date funds, you're kind of messing up the allocation. So yeah, I mean, and kind of going back to that, what I was talking about younger, we look at this is if you had an all stock portfolio, the gray bar, versus a moderate 60% stock, 40% bond portfolio, the green bar. This shows over various time periods, going back to 1989, the frequency of positive returns. And if you have less time to recover, then yeah, maybe you shouldn't be in a 100% stock portfolio. You can see over a 10-year period, you still have a 7% chance of having negative returns over that 10-year period. It's smaller the longer that time horizon. And so kind of when we go to short-term goals, when clients go like, oh, I'm looking to save for a house or buy a car in the next year, we probably wouldn't recommend a 100% stock portfolio for that goal, because you see you've got a 82% chance to be positive, but it could be less. And if you're going, I can't afford to have it be less, or I don't want to buy a smaller home or a cheaper car because it may be less, then that should probably be in cash equivalents, or bonds. And then vice versa, looking at the green bars, if you're heading into retirement and or you're needing that money to last you, depending on your time horizon, you see it's at least historically over a 5 to 10 year period being in a moderate 60-40 portfolio. And these are rolling return periods. It's been hard to lose money if you stick to the plan and stay in the portfolio and stay in the markets.
Right. The argument to that is, okay, well, the US has never seen this, or we've never had this happen before. You go back in history, all those one-time events never happened prior. The markets are efficient, right, Mike? Would you say that they could adjust to what's going on in the
Very quickly.
economy?
Markets are, for the most part, I mean, especially large markets like the US stock market, S&P 500, they're very, very efficient at pricing in news very rapidly. And I mean, we're not cherry picking, I mean, numbers here. I mean, it goes back to 1989, but this shows up through a financial crisis, 2008, a pandemic, the housing crisis, I mean, or the Resolution Trust in the early 90s. You name it, we've been through it during this period of time. Will it look different in the future? Will we go through something we haven't? Possibly. Mark Twain says history doesn't repeat, but it often rhymes. So
Next slide, Keith. Next slide. This is
yeah. Is that on the next slide? Well, that's another Twain. Yeah, Mark Twain has a lot of quotes I like. And this one's more about timing. October, this is one of the exceptionally dangerous months to speculate in stocks. The others are July, January, September, April, and so on. As a joke that it's always a dangerous time to invest. Mark, there's always noise out there and news, but again, markets have found a way to climb that wall of worry. Another great quote from legendary investor Peter Lynch. far more money has been lost by investors trying to anticipate corrections than has been lost in all the corrections combined. Which is, I mean, so true. And the point stands, it's time in the market, not timing the market, that gets you to where you want to go.
Yep.
And so Keith mentioned earlier, I mean, and time in the market, not timing the market. Moving to cash, it rarely pays off. And again, it's two right decisions, when to get out and when to get back in. And some people uh, think, oh, I can get out, but it's really hard to get back in, and because that recovery happens very rapidly. And just using the example of this year, March, a downturn in the markets, and then a very quick subsequent recovery in April. And that recovery happened before the all clear signal. We're still in a war today. So it's very quick, very hard to time those downturns. And this is just showing you, I mean, the percent of underperforming the longer you stay in cash. Everyone should have a emergency cash reserve, cash for any short-term goals that you have, and so on. But cash typically is not a long-term investment strategy. We recommend stocks and bonds and other assets. Cash doesn't usually keep up with inflation. So. And going to timing in the market, it's again virtually impossible to anticipate with perfect foresight. And there's so many moving parts that the economy is so complex. You got interest rate moves, you got unemployment, corporate profits, natural disasters, pandemics, wars. And so to go, oh, I know one thing that's going to trigger the decline in the markets, it's very, very difficult. And in this example, just missing the best 40 days from January 2026 through the end of 2025 would have actually produced a negative return, or gotten close, yeah, a negative return, compared to an 11% return for an investor who stayed fully invested during that same period. And that's just 40 days from 2006 to 2025. If someone can tell me when those best 40 days were going to happen, then we'd all be really rich. But I don't think anyone has a crystal ball to tell us that.
Yeah. Just think about the thousands of trading days that there were during that time period. You miss just 40 of them, it has a pretty significant impact here. You can see that. So it's one of the more powerful slides, I think, for staying invested.
And finally, I mean, if you are worried about downturns, then staying diversified is one of your best weapons against that. When you spread your investments across stocks, bonds, other asset classes, that's historically recovered from market downturns much faster than a concentrated one. So rather than trying to guess when a decline will end, staying diversified and staying invested historically shorten that path to break even. And that's what this slide is showing you, comparing both negative stock and bond years and on the top, versus a 60/40 broadly diversified portfolio. And you see the time to recovery and the odds of being negative months or years later really shrinks. So again, that 60/40 portfolio, 3 years after a negative event, this is since 1976, you only have an 8% chance based on history to still be negative in that 60/40 portfolio.
So I guess, Mike, in other words, just again, we talked about this, just take a step back and distinguish between what you cannot control, like the markets, the economy, interest rates, inflation. We can't control that, but that's always our focal point. So it's tough to detach yourself from that. What you should be doing is focusing on what you can control. How much are you saving? How diversified are your investments? Are you following that plan that's customized to you? And more importantly, your emotions when you stop and think about it. That's what we base a lot of I mean, would you agree, Mike? We base a lot of our decisions on emotion when it comes to investing in the
Yeah,
market, right?
my undergrad is in psychology. I got into accounting and so on, and where I am today in finance. I did not think I'd be using my psychology undergrad degree as much as I do. And controlling emotions are very, very difficult. Chad, I'll give a plug to Chad and his behavioral investing and series. If you go to our website, there's a short series on controlling emotions and different behavioral things that we do that make ourselves our own worst enemies. So check that out.
I'm sure it's good stuff. Okay, again, mentioned this in the beginning. We're going to talk about diversification quite a bit. Why it's so important. So I know there's a lot going on this slide, but this chart runs from 2011 through 2025. So each shaded block represents a different asset class or investment style. You'll notice here, and they're ranked from top performing to worst. You'll notice how frequently the leadership changes from year to year. So I'll point out in 2017, for example, emerging markets were the top performer, number one. We fast forward to 2018, what happens? Emerging markets go from first to worst. No one can say with confidence which asset class will lead next year. So again, that's why it's so important to own all the various asset classes rather than focusing on or concentrating on just one. And the big takeaway here, more than 90% of your overall returns in your portfolio, they're typically derived from how you diversify that portfolio. So I don't know if you have anything to add to that, Mike, but this.
No, I mean, I kind of use the analogy like if for either baseball fans or golfers, the white box is showing a more diversified portfolio across these asset classes. And I'll use the baseball analogy. If you're constantly swinging for the fence and going for those home runs, you're concentrating in one asset class. But what do those home run hitters do? They strike out a lot, and that's why you see that volatility, like Keith just gave with the emerging markets asset class. If you blend all these asset classes together and stay more diversified, you produce more consistent batting average returns. You're maybe not swinging for the fences, hitting tons of home runs, but you're avoiding those strikeouts and that if you can produce more consistent returns, and again that comes back to the compounding of that wealth, then that should benefit you over the long run.
I mean, I love this one too. Go back to that real quick, Keith, because you mentioned emerging markets, and I just think back to 20 years ago, what was the most popular topic out there was you got to put your money in emerging markets. China and India, all these economies are going to boom. It's not that they didn't boom, but EM broadly is the light purple that spent the better part of the next decade towards the bottom half of this page, right? And same thing, that's coming out of global financial crisis in 2011, where this chart starts, and oil was black gold, and so commodities should do well, but commodities, broadly speaking, when you put all of them together, are at the bottom of the page almost every period over that 15-year period. And which one was at the top? Coming out of a housing market bust and a real estate crisis, the top performer for like 4 of those next 5 years was REITs, which is real estate, just broadly as an asset class. So like the exact opposite of what so many people would have thought were going to perform well, actually spent time at the top and bottom. So
and this changes. I mean, this is this 15-year period, but if we would have looked at the 15-year period before that, emerging markets, real estate were some of the top performers, and commodities heading into that prior period. And so the rotation is constantly happening. You may have a multi-year period. We've been through a multi-year period where large U.S. stocks, the S&P 500, that are tech dominant, have just been on a roll, and you see that. But that could change over the next 10, 15-year period.
There's that rotation, but you can't predict it, basically, right?
Yeah.
Okay, so I think by now we've talked quite a bit about it. It's important to own that diversified portfolio, take that long-term perspective. The third thing we can control is monitoring and rebalancing our portfolios as the markets experience volatility like we are right now, because we want to make sure we are staying within our risk tolerance for investing. So for example, let's say you determine that, 70% stocks, 30% bond portfolio, that's the right mix for you. So if stocks have a strong year and now make up 80% of the overall portfolio, what happened? You're taking on more risk than you intended. So right here, this is an opportunity to rebalance. So essentially selling 10% of your stock position and then add it to bonds to get back to your target, right? That was your initial original intention. And Chad, maybe you can speak to this. You mentioned this earlier. Most retirement plan providers offer automatic rebalancing. It's on a set schedule, right? Whether it's quarterly,
Yep.
semi-annual, annually. So that kind of keeps you in that right allocation. So you don't have to worry about it. Like you said, it's a set it and forget it approach. But are there certain bands when it gets to a point that they go in? How does that, maybe the group would want to hear how that works a little bit.
Yeah, good question. So if you're using any of like the model portfolios or a target date fund, this automatically happens for you every single day. The target date fund is rebalancing your portfolio. If you've picked your own allocation, right, and you just pick, I want to use this bond fund and this stock fund, this international fund, maybe a little bit of cash, fund in your portfolio. On the website, the provider will give you an option for how frequent. They don't actually use bands. It's not like say 10% out of my portfolio and they're going to rebalance for you. They'll ask you, do you want to rebalance every quarter, every 6 months, or once a year? We typically tell people if you have quarterly as an option, select it, but at a minimum once per year. And the reason I say once per year is you have the last couple of years as a really good example, right? Coming out of 2022 with the market down double digits, 2023 market was up S&P more than 25%. In 2024, exactly the same, up right around 25%. And then last year, even with the market being down double digits in the first quarter of 2025, the market ended the year up about 18%, right? So that's 3 consecutive years of booming markets. Now, if you had just not done anything and left your portfolio in that 70-30 stock portfolio, it might have ended the first year at 75 to 80% stocks. It might have ended the next year if you did not rebalance at 85 to 90% stocks. And so by the time you got to this year, 2026, and the market again started the year very rocky before recovering, a 90% stock portfolio would have been down a lot more than a 70% stock portfolio, right? And so it's just like, that's not what your risk profile told you to have, 90% stocks. Like your risk profile said, I'm good for 70% stocks. And just making sure you're always aligned with your financial plan and your risk profile, one of the most important things.
Really, rebalancing is kind of forcing everyone to sell when things are high and buy things that are low. And so it's again, it's not a timing mechanism, but it's helping you trim those things that have done really well the last couple of years and buy things that haven't done as well. Because markets have a tendency to revert back to the mean or partially revert back to the mean. So it's as Warren Buffett said, don't be greedy. Be greedy when everyone else is fearful. So rebalancing not only helps you manage your risk profile, but it's just a natural way to take advantage of trimming and buying different opportunities within the portfolio.
Yeah, I think in other words, so you're selling a winner to buy a loser. I mean, that's really what it is. And that's difficult to do on your own. So having disciplined automatic program like automatic rebalancing takes that emotion, right?
Yep.
So that's why we wanted to talk about this as well. So. And then just to kind of tie everything together here, a few tips to leave you with today. First, build that diversified portfolio based on your specific risk tolerance. And I think what's important when I say that, determine what that risk tolerance is now, not after the markets have already fallen. And again, second, take that long-term perspective on your savings goals and stick with your plan. This is a marathon, it's not a sprint. That's really important when we talk about retirement plan. Because it's really easy to waver or jump ship, but stay in the course It's what helps you reach those retirement goals. And then what we just talked about, keep an eye on your portfolio, rebalance it on a regular basis so you don't end up in an overly aggressive or risky position during a bull market. And that happens like clockwork. So, and then lastly, remember that savings, that's a real driver of a successful retirement. So in doing this for so long, I'm sure, unless Mike's heard differently, I have never heard anyone reach their first year of retirement and say, geez, I wish I would have saved less for retirement. So.
And we mentioned doing contributions to retirement plans, other accounts. That dollar cost averaging and consistency of saving, it really helps. We don't have a slide on it, but it helps smooth out that volatility, because sometimes you're investing at or near market highs. Other times, if market's corrected, you are buying at the lows. So it helps kind of smooth out the volatility, and again, it takes the guessing, and it's more of an automated way to invest.
Yep. 100%. So you're not buying a lot when the markets are high. You're buying a lot more when the markets are low, when things are on sale, basically, right? Just like going into a store, to kind of use that.
With that, we do have a number of questions here. I'm going to answer a couple of them with you a couple different ways, but I'm going to start at the top because it already has 2 thumbs up. And again, reminder for the group, we build these things. We hope they're only ever 60 minutes, including Q&A, but we actually build them for 90 minutes now because we get so many good questions so frequently, and we'll stay on the line until that last question's answered. So for any of you that do need a drop at the end of these remarks or at the top of the hour, thank you so much for joining us, and stick with us as we go through some questions. The first one is, does compounding work better for different accounts or combining accounts? Example, IRA versus 401k versus rolling over 401k into IRA. I'm gonna let you answer that, but let me answer the quick and basic one first. Is if it's the same exact investments, right? Like pre-tax IRA versus your pre-tax 401k, or a Roth IRA versus your Roth 401k. If you're using the exact same investment option, right, like the S&P 500 index fund, compounding theoretically should be identical. Now, that could get more complex, though, if you think about the differences between these tax-advantaged accounts versus taxable accounts and what types of investments to include where. You two want to address some of that?
Yeah, I mean, one of the things we do for clients we're managing money for is location of those assets. So I'll give the example, like a Roth IRA or Roth 401k, it's growing tax-free. You want to try to get as much growth into that account as possible. When I say growth, that means more equities into that account, because it's going to compound at a faster rate and it's growing tax-free. Whereas maybe on like if you have bonds in your portfolio, and you have a taxable brokerage account that's getting taxed each and every year, versus a 401k, and you want bonds as a part of your total allocation, you should be sticking the bonds in the 401k more, because bonds typically produce interest, which is taxed at ordinary income tax rates. Stocks typically produce capital gains if you realize any, or ETFs typically avoid capital gain distributions, or dividends if you hold them long enough, qualified dividends. So those are better for taxable accounts. So we look at it more from a tax perspective on locating those assets. But like Chad said, if you're going to hold the same exact holdings in every single account, the growth rate and the compounding is going to be the same outside of the tax.
Yeah, and I think specifically this question says IRA versus 401k, and right, the tax situation is likely identical between those two. So the difference in compounding is not going to be better or worse in one or the other. But as soon as you add a taxable account, all of that changes. I think the other thing to think about in IRAs and taxable accounts is, not every option, like an ETF, automatically is dividend reinvesting available, or buying a stock and it automatically reinvests the dividends from that stock. In a lot of brokerage platforms like Schwab and Fidelity, you have to turn on dividend reinvestment. So like if it spits out a dividend for you, it might just go into your cash bucket in your IRA or your taxable brokerage account. right? And the ETF for stock might continue to grow in value, but your cash is growing in value because of the dividend. In the 401k, dividend reinvestment is automatically always turned on for you.
Yeah.
So it's something to pay attention to. It should be about the same, but it could vary.
I think just to kind of piggyback off that, what Mike said, actually, with the Roth, you can afford to be more aggressive in. If you don't need that money throughout retirement, you never have to take it. So what are you required to do when, depending on your birthday, you get to a certain age, whether it's 73 or 75, you have to take a required minimum distribution out of those pre-tax accounts. So the window's a little bit shorter. With the Roth, you get to that age, it can continue to compound and compound. You never have to take that money in. So let's say, for example, you have a major unexpected expense late in retirement. The Roth is sitting over here growing at 5-6%, whatever the case is. You're going to have a great bucket to build tax-free, maybe pay for that expense without having to take money out of a 401 and pay taxes. So there's a lot more that goes into it.
Okay, next one I get to, we talked a lot about rebalancing today. I'm going to give you call it the basic answer first, but then let you guys, if you have the data for it, it says if we rebalance once a year, right? Do we have any data on which month should be the practical month to do rebalancing? It's what I'd say is the most important thing. We talked even more about timing the market is pick a month and never change it, right? Like the day of the year, whether it's in January or in April or in October, if it is always the same over the long term, it's going to average out anyways.
I will give a seasonality answer to this. There's the old adage, sell in May and go away, because markets historically hasn't been the case for the last number of years, but have a weak period, typically between June through October. So I typically tell clients if they're doing a once a year annual rebalance, have it set in kind of like May or June. And just, but like I go back to what you, Chad, I echo that sentiment. It's just pick a month and stick to it.
Yep, consistency for sure.
Yep.
Okay, I got two left, unless some more come in. So hopefully we get a few more questions in here. Next question is: would contributing to funds according to what you want more of help as opposed to rebalancing? In other words, like getting the percentage goals through present contributions rather than rebalancing everything. So let me start with that because I'm going to give it to Mike to go deeper into that. Yeah, the inside of a 401k plan, it just doesn't matter because you can click an option to rebalance every quarter and your new top contributions go in. And it's more efficient to say rebalance every quarter or once a year, rather than having to go say, hey, I want to put 1 more % into this fund or this fund or this fund. Just because the tax situation for all of them is the same, and you're not going to pay taxes like capital gains tax for selling one to rebalance into another portfolio. I think when you get into the tax location Mike was talking about, this question is exactly what Mike does. Mike doesn't just take a portfolio necessarily and rebalance from one to the other all the time. If there's new money, he'll be very specific about where that should go, trying to monitor for, not trying to trigger, taxable events for clients in their portfolios as well. Mike, you want to talk a little bit about that after you've read the question?
Yeah, I mean, I would agree. In your retirement accounts, it doesn't matter. And I think simplicity and automation is way better than trying to constantly worry about, oh, I need to shift a percent here and there. Yeah, taxable accounts, you definitely want to be mindful. And we look at everything, I mean, kind of like on a household basis. You may have a 401k, an IRA, Roth, a taxable brokerage account. And we want to look at everything. I mentioned that tax location of assets. We don't necessarily position each and every account to look the same, placing different assets in different buckets. And if I have the ability going, oh, I need to trim this asset class or equities or something like that because they've run up in price and I need to get back to my target. Do I have the flexibility to pull that lever in a tax deferred account where there's no tax issue? Then that's what we'll do. And always being mindful of taxes. That we try to focus on the things that we can control, keeping expenses low, keeping taxes low, making sure you stick to your long-term plan and then let markets do what they do. And if you're constantly trading your portfolio and generating short-term gains and everything else, you already are creating a hurdle where you need even larger gains to offset those taxes that you're paying. But using contributions, withdrawals, it's kind of trying to stick to a balanced plan as much as we can with through the use of different accounts for sure.
Okay, next one I got, and I'm pulling a couple from the chat box as well that came in and aren't in the Q&A box. But again, please still continue typing questions if they come up. Next one I have is, what investing advice do you have for a student entering their final year of college, getting ready to graduate and enter the workforce? You could have a lot of people on here in that, and then some students, but also a lot of parents with students in that phase.
Keith, I'm going to let you tackle that one.
Well, and I was going to put this actually back to you. I mean, the general 30,000-foot view without understanding your risk tolerance for investing. I mean, you can throw a lot of this out the window until you figure out, can you sleep at night if the markets drop 20 or 30%? But we talked about this. You can afford to be really aggressive early on as long as the portfolio is diversified. And many times when I'm working with younger participants, they will have everything in just one index. So at least as a diversification measure, maybe going like, and this is where I put it back to you, Mike, like a total stock market index,
Yeah,
picking up international and so on and so forth. And that's the general thought process behind that, and explaining what that means versus just being that one single index.
absolutely. And then I would say my advice is just start today, start saving. The
Yep.
sooner you can do it, the more years you have to compound. And and for those who haven't started and got a late jump, it's never too late. Just start investing and start saving.
And you can, I mean, you can go to what? Not that we're endorsing any, you can go to a Schwab, Fidelity, Vanguard. They have ultra low cost funds to own right now. You can get out of them. You're not locked into these accounts. So you have plenty of opportunity now to go ahead and build that diversified portfolio, and they make it convenient for you.
Just because I feel like there's probably quite a few people who will be sitting in this bucket or close to it or entering it. I mean, other things just to think about is because we have so many employers here as well on this line that have employees here is as you start your career and where you're going to work, do you have student loans? What's the interest rate on those student loans versus what you're going to make in your investing portfolio? Does your employer have a retirement plan available to you, which almost everybody on here does? And do they have an employer match, right? Not all companies or organizations have an employer match, but if they do, at least saving, right? Even if you need to pay off student loans, at least saving in that retirement plan to get the match is like getting free money. And if you don't save at all for retirement, you're not getting that free money. And then balancing based on your employer savings and any student loans or other debts you might have and credit cards that you hopefully don't have a balance on, but making sure those are being paid off. And then figuring out where to invest beyond that as well. I'd say don't not invest just because you have student loans, right? Or you have a credit card, balance at some point. At some point, you might always have one of those balances and you just never start investing because there's always a balance that gets paid off. I go on vacation, you have another balance again. But trying to balance, right? What are your different goals, objectives? Short term, do you want to buy a house versus a car versus vacations versus employer match versus student loan interest rates? Are all things that go into the factor as you're getting ready to come out of college and begin your career.
Yep, absolutely. And take advantage of that free money, like Chad said. That's a great point. And also, when you're going through the 401k, you're setting that on autopilot. You don't even see it. Once your direct deposit hits, so you can't spend it, right? Because this is a retirement plan, and I literally can't emphasize enough those little things starting earlier, whether it's 1% or a 1% increase in your contribution, it has a tremendously positive effect over a 30-year working career. And then I've seen it firsthand. So that's a great point, Jim.
Yeah. Okay, the next one I have is going to go, I think, to the opposite side of the spectrum, to more complex. Is can we share anything regarding new, like real property tax decisions, and any way to kind of freeze those into retirement?
Not quite understanding the question. Yeah, I don't quite understand the question, so maybe that person could reach out to us offline and share some more details, and happy to try to address that.
Yep, we can. I can reach out. All right. Awesome. With that,
Chad, before we conclude, I wanted to jump real quick. Can you go to the appendix for those
uh,
of us still with us?
Where am I going? Do you know? Just tell me when
Yeah,
to
yeah, you're
stop.
driving it, Keith. Keep going to, yeah, this one. Wanted to share a couple things just since they're top of mind with clients. The one right before, and then we'll come to this one on elections. Yeah. So, well, question I wanted to kind of address a few things that we're hearing. We got midterm elections coming up. Political noise has been loud as of late, and we're not going to sit here talking politics. It's the fastest way to have everyone arguing at the dinner table. So so no religion, no politics on this call, but we do want to more show this chart for historical reference of stocks have trended higher regardless of the presidential party, Congress, and so on. Maybe there's been different rates of return during any period and so on, but uh, again, we're trying to ignore these election years. While they may bring some short-term volatility around the uncertainty, but the data shows staying invested through election cycles rather than trying to position around the outcome is generally been the better approach. And
You want me
Keith,
to go
if
to
you,
the next one?
I'll go, yeah, go to the next one, yeah. Um, And just on geopolitical sell-offs, we saw that happen in March. We're still the conflict's still going on again, off again. And so you see, I mean, while it remains fragile, geopolitical shocks like this, including wars and other conflicts, they typically cause that sharp but short-lived market reaction. Um, and then typically they recover within a few weeks to a few months. And that pattern, looking at these other historical geopolitical events, happens, and then that pattern is largely held up time and time again. The ones you don't see on here are typically ones that lead to world wars, where that pattern was slightly different. So, but even that, I mean, markets climbed back from those, and actually World War II helped us get us out of the depression. So it was a good thing from the market standpoint.
Yeah, good stuff. Good stuff.
Um, and then yeah, last thing, Keith, if you could, sorry, go back just since Chad asked it on gold. I'm going to talk about that real
It
quick.
was the next, yeah,
Yeah,
we'll
that
get
one.
our best.
So we had a slide on gold, and as I kind of referenced earlier in our comments, is gold's hasn't necessarily been the best at tracking inflation. As I kind of mentioned, in the early 70s, you saw it did very well, but since then it's been all over the place, and gold just has shown extreme price swings compared to inflation. And so it may be reasonable to hold a small position in gold. We're not anti gold, but it's definitely got more extreme price swings, and the argument that it's a good inflation hedge is hit or miss. If you go down to the next slide, Keith, um, stocks have historically been better inflation hedges, as I alluded to earlier. Um, so we typically favor, and history shows that stocks tend to outpace inflation over time. So if you're worried about rising prices, which everyone should be to some extent, we're not in the camp of rapid inflation. We're the next banana republic or anything like that. But inflation is here and will always be here to some extent, outside of maybe brief periods of deflation. But stocks are the better inflation hedge. And if you go to the final slide, um, again, it's all about maintaining a balanced portfolio. We talk about gold as an inflation hedge, and maybe it's not the best inflation hedge. Gold does, I mean, do better in high risk geopolitical risk regimes, typically, not always. We saw that just with this geopolitical conflict with Iran. Gold had a very strong 18, 24 months up until that, and then it fell during the conflict, and it's been weakening. So that's not always the case. But if you look, the chart on the right is showing going back to 1988, the performance annualized returns of the S&P 500, U.S. stocks, the green bar, the lighter green bar, a 60-40 moderate balanced portfolio. It's that kind of a forest green, the gold, the yellow, and then blue bonds, and then the volatility. And so you can see gold, I mean, has the second to worst returns during this period we're presenting compared to bonds, the least risky asset class, but gold has the highest volatility. So the amount of extreme price swings. So again, that's why we typically, if you want to hold gold in the portfolio, it'd be a small portion because it can drive a lot of the volatility. And again, a non-income producing asset. So just since you touched on that, asked that earlier, Chad, I didn't want to jump all the way back here during the middle of the presentation. So,
yeah, awesome. Thanks, everyone. I think that was the last question we had from the group today, too. I'll reach out to that one directly and see if we can get a response back and some clarification. For everybody else, thank you so much for joining us today. Keith, you want to go to the next slide so Mike doesn't get mad at me for not making you put that?
I got it, Chad. Yeah, I've done this once or twice. Thank you, though. Yes, I'm here.
Awesome. Thanks, gentlemen.